Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Welcome back, folks. Today, our special guest is Joel Block. Very, very experienced all around kind of Renaissance money guy. I mean, Joel was telling me he got his start as a professional gambler in Las Vegas, and then went from that to working in venture capital, creating hedge funds, helping people raise capital. So we're going to have a very interesting conversation today. Joel, welcome to the show. Great to have you.
Hey, Dave, thank you very much. Thanks for having me.
All right. So I did a fumbly bumbly kind of version of an intro there. Maybe you can give us a Coles Notes version of how you got into this whole world of venture capitalism. And
believe it or not, I was a CPA early in my life. And I was at Price Waterhouse, the big accounting firm. And the last assignment that I worked on there was converting the books and records of 500 partnerships into tax returns for a giant syndicator.
Wow.
And that really is how I learned this business. And I really realized that I hated doing the tax work, but I love reading the partnership agreements. And, I just knew that I wanted to be a deal maker, not a tax doer. And off I went. So I left the firm, met another guy, and he and I started a little syndication firm in the late 1980s. We made our first money, pretty good money in those days. And then I fell into a venture capital transaction, and I got a pretty big company to give me $10 million for a concept that I had. I didn't have a business plan. I didn't have much of anything, but it was a concept. And once you learn how to raise money, you can raise money for anything. So if you learn to raise money for real estate, you can learn money to raise. You can raise money for film. You can raise money for any kind of a deal you want. And
what was, just out of curiosity, what was that concept that you raised?
The concept was delivering stock quotes to investors by fax in 1990. So that was very revolutionary. 5 years before the internet. It was really revolutionary. And one of the biggest media companies in America wanted a piece of the action of this deal. So they gave me $10 million to make this happen. And we made it happen. I got Wall Street to buy into it. And I got 35 of the biggest newspapers to run our ads on a revenue share basis. And it was literally all over the country. There were thousands and thousands of people that would get these faxes every single day.
Was it a subscriber thing, or was?
Oh yeah, no, it would. Yeah, they would pay a couple $100 a year to subscribe.
Yeah,
it was all over the place. I mean, it was everywhere.
Nice.
And people laugh at it because they think it's so silly. But 5 years before the internet, this was revolutionary. We pioneered.
That was you, yeah.
We pioneered the concept of auto renew by credit card. No one had ever done this before, and we did it. So it was quite an experience. And I ended up selling out to the media company, and they treated me very fair, and that worked out just great. So,
nice.
And I had a partner in that deal, and the two of us, we did very well. So. It was an excellent thing, and then I spent.
So sorry, I interrupted you, but yeah, you're talking about like once you learn the skill of raising capital, you can raise it. But
Listen, raising capital is an awesome skill because once you learn that skill, you can apply it to anything, and and doesn't really matter what you apply it to. So that's all the more reason to learn that skill. And I'll tell you something, for younger guys in particular, learn that skill.
Yeah, very good. So these days, fast forward to 2026. What are you focusing on primarily these days?
Well, I had a hedge fund for a long time. I retired from running that fund, and now I'm advising and working with CEOs of public companies who are having some kinds of capital problems. And these guys have all kinds of problems. Like, you'd be surprised that they just don't optimize a lot of their activity. And they get a little sloppy because they're public. They think they can just use stock or they can just use other vehicles. But there are lots of ways to finance things. That's what Wall Street is great at. Wall Street's great at matching risk with the right kind of capital.
Right.
And the shares of stock or borrowing hard money or whatever it is not always the best solution. So I'm kind of helping some of these guys. And actually, there's a couple of companies that I'm looking at getting particularly involved in, maybe taking over a division or two of a couple of different companies. So not as an employee, but kind of as an outsider.
Got it. Now, you've also worked with real estate investors over the years as well.
Oh yeah, most of my experience is with real estate.
Yeah.
My hedge fund was real estate. That was almost 15 years from 2010 to 23 or 13 years. My early days was all real estate, but it's been real estate and venture capital. Those two categories are kind of my big categories.
Got it. So with what you're doing right now, without giving away names or anything like that, maybe walk us through a case study of a client that you're working with.
You know, um, there's a medical device company that is buying clinics. And I
Wow.
said to the CEO, how are you buying these clinics? And they're borrowing money from these hard money lenders. Now, a hard money lender in the stock market's a little different than in real estate because they're not securitizing against the real estate, they're securitizing against the company. So they're
Right.
usually getting stock. They're tremendously expensive. It's very painful for the company, but they don't perceive they have any other options. And just like in real estate, these guys, they run out of borrowing capacity after a while. I mean,
Hmm.
it's not uncommon that when you're borrowing or you're doing something like that, eventually the lender says, enough's enough. We're not giving you any more. You can't really support anymore. And because the debt is very expensive, these clinics that they're buying are never cash flowing enough to support the debt on these properties. So they get themselves into some trouble. So I
Hmm.
said, maybe be better to syndicate this. Maybe it would be better to bring outside investors, small investors, who instead of relying on the public company,
Yeah.
are relying on the clinic to cash flow.
So
So
investing in individual clinics versus the whole
exactly,
company.
that's
Oh,
right.
okay. Yeah.
So and they might get warrants and they might get options in the public company, which would be an appropriate thing to do.
Hmm.
But their tolerance for risk is lower, so it's much softer money because they're getting cash flow from the clinic. They're not really dependent on the public company and some of its machinations. They don't have to worry about that. So it's the same business. It's the same thing you do. It's what I did for a long time, applied to a different asset class. And these clinics all involve real estate. They all involve personnel. I mean, it's all the same. That's why I'm
Hmm.
saying that once you learn how to do it, you can do it for anything.
So based on your experience there, Joel, when you're teaching people or showing people how to raise capital, how do you recommend they get started? Like if somebody's just kind of starting from scratch in the capital raise.
Well, first of all, raising capital is a little bit of an advanced technique. You kind of have to start at the level where you are. Uh, no investor is going to give you money so you can practice with it. I mean, that's just how it is. You have to go cut your teeth, however you do it, bird dog for somebody, ride along on somebody's coattails, learn how to do it, do 3, 4, 5 deals. Once you've done that, then you can go to an investor and say, look, I've got some experience. I've got my hands on a property that's really good. Now, uh, I'm well known as a deal architect, a structurer. I structure deals and transactions, relatively complicated. I like to set up things in a more complicated way than a not complicated way, and here's why.
Mhm.
People will say, "Well, I don't really need it to be that complicated." And I'll usually say to somebody, "When you first got married, did you buy a one-bedroom house?" Well, no, no, of course not. I bought a three-bedroom house because we're probably going to have some kids. I said, "Well, that's the same thing with this. That you want a little more complicated structure than you think you need because you're going to grow into it. And let me assure you that when you grow into it, you're going to need the complexity that these structures give you. And let me promise you that." The structures are for the benefit of the syndicator, not so much the benefit of the investor,
Mhm.
because these buttons and different things that we build into these things are really so that the syndicator can control the transaction the way that they want.
Right.
And that is very important. You may not understand why something is important now, but let me promise you that later on you'll understand it very, very well. So we have built structures, hundreds of structures, and we typically build them as funds, not as syndications. A,
Okay.
a syndication, just for everybody's reference, is a project. You buy an apartment building, you raise the money for it, you do the business plan, whatever the business plan is, whatever the fixed thing is that you want to do. You sell it, you give the investors back their profit, you take your profit, and then you give them back their capital. You wash your hands, and now you're done. And then you say, I want to buy another building. You got to start all over again, go back to the attorney, get a
Right.
new set of documents, and start from scratch and raise all the money. A fund is the same, except that you pass out the money to them, you pass out the profits to them, you keep the profits for yourself. But instead of giving the capital back to the investors, you have their permission to redeploy the capital and keep it going.
Right.
And
One can evergreen versus one off.
yeah, funds are more like a business.
Yeah.
And you call evergreen, it's exactly correct. It's a business, it just keeps going. Whereas a syndication is really more of a one-off project. So
Yeah.
it's a project versus a business. And if you're better at deal sourcing, I mean, if you have poor deal sourcing skills, a fund is not a good plan for you. But I would hope that most of these people who are listening that are in the real estate business or attached to real estate would have very good deal sourcing skills, because otherwise you're running around spending your whole life raising capital deal by deal by deal. And that makes it very difficult for you to get the very best deal that's possible. Because if you go to a seller and you say, listen, I'll give you a discounted price, but I need a couple months to raise the money,
Yeah.
forget about it. They're selling it to somebody else. But if
Yeah.
you say, listen, I got the money ready to go, I can close in 2 weeks, you're going to get the lowest price that anybody's going to get. And the investors know that, and the investors are happy to share those extra profits because they help you put the bullets in the gun. That's how it works.
Yeah. Well said. So back in the day when you were actively raising capital for deals there, Joel, what did you find worked best for connecting with new investor prospects besides
Well,
besides
yeah.
referrals?
Yeah. Um, well, first of all, I am actively raising lots of
Oh,
capital
yeah.
as we
Okay.
speak.
Sorry. Yeah.
Um, what you have to do is you have to align the right kind of investor to the right kind of deal. You got to match the money to the deal. And what newer investors misunderstand is just because a guy's got money in his bank account has nothing to do with him giving it to you. I mean, that's
Yeah.
just
Well said. Yeah.
right. I mean, that's just kind of how it
Just
is.
because they can doesn't mean they will.
Yeah, exactly, because they can, I mean, they will.
Yeah.
So, you have to give somebody something like that makes sense to them. Like, if you got a guy who is regularly in the stock market and they don't like real estate, they're not giving you money for real estate. Just that's
Mm.
it. You got to ask the guy, have you ever done these kind of deals before? Do you like real estate? You know, and the guy might say, not really. I really just prefer the stock market. Then don't even bother. I mean, it's like, that's my experience. My experience is, and I've been doing this a long, long time. The better job you do of finding somebody. Now, for example, when we set up funds, we usually set up a theme for the fund because, you can't just say we're going to buy any property we find anywhere we
Right.
want in the United States. You kind of have to put some parameters around this because otherwise the investors are not going to say yes. And the only goal that you have as a money raiser is to get someone to say yes, right?
Mhm.
So you might say, we're going to do industrial, we're going to do residential, we're going to do commercial, because different people understand different asset classes and they don't understand the other kind. So if you ask someone who likes commercial real estate properties to do houses, they're going to say no.
Mm.
So you kind of have to understand what they want. You also want to understand what their geographical likes are. And let's say it's Southern California. Well, you might not just say Los Angeles. You might broaden that out a little bit to the southwestern part of the United States. And then the investors can say, you know what, if I feel like getting on a plane and looking at our stuff, I could do that. They're probably never going to do that, but they could if they want to. And that's
Right.
the reason that you put some parameters around how you're going to operate here. So, the better job you do of matching and putting some constraint, not constraint on yourself, but really constraint so that the investor can understand what you're going to do. It is a rare, rare person that an investor will say, go do anything you want, anywhere you want. I don't care. Just don't mess it up. I mean,
Just
there's
take my
a
money
few,
and do a good job with it. Yeah.
yeah,
Easy.
there's a few of these Wall Street guys that are famous. Elon Musk can get away with that. Nobody
Mhm.
else can. I mean, there's
Yeah.
not very many guys get away with that. None of us listening to this show, you included, can get
Yeah,
away with that kind of game
exactly.
plan.
Yeah, most definitely. Joel, this has been great. So if people are wanting to get more Joel Block, I think you mentioned you had a podcast. How can people find out more
Yeah,
about that?
probably the best thing, go to my website. It's called theadvantageplayer.com. Theadvantageplayer.com. There's contact information there for me, and you can access that information, and we'll go from there.
Sounds good. Joel, thanks very much for being on the show.
Happy to accommodate. Hope it benefits some people.
I'm sure it will. All right, everybody. Thanks for tuning in. We'll see you again on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviewyou.com.